appreciated, rupee has depreciated. Yes. If it is floating, if it is managed, yes. If it is done by the government, if it is a fixed exchange rate, if it is done by the government. Now, what is the term used there? Whenever the value of one currency goes down, we use the term devaluation, and whenever value of another currency goes up, we use the term revaluation. Now, in the same example, instead of market forces, if it is done by the government, can I say value of a dollar has been revalued and the value of rupee has been devalued? Any problem here? Please do let me know. If it is not market, if it is done by the government, can I say example 1, value of rupee has been devalued, value of a dollar has been revalued. This is basically the set of terms used, right, in case of floating exchange rate, in case of fixed exchange rate. Any problem? Can I go forward now? Can I go forward? Look at example 2. Look at example 2. Can I say in example 2, between now and after 1 year, between now and after 1 year, can I say rupee value has been appreciated? Rupee value has appreciated, dollar value has depreciated. Look at example 2 now. And on the other side, can I say if it is done by the government, rupee has been revalued, dollar has been devalued. So logically understand this, the terminology, revaluation and appreciation. Impact is same. I hope you understand. Impact is same, but the difference is whether it is happening because of market or it is being done by the government. Right? Whether this is being done by the government or it is being done by the market, that is a difference. Impact is same. Value of one currency goes up against another currency. Right? Which means, right, it is either appreciation or revaluation. But if it is because of the market, we use the term appreciation. If it is because of the government, we use the term revaluation. That is basically the argument. Can we go forward now? What is the impact of fixed exchange rate on the economy? Arey Baba, somebody is asking, is the break over? My dear, the break got over 20 minutes ago. Please refresh. So what is the impact of a fixed exchange rate? If there is a fixed exchange rate, can there be a scope for devaluation done by the governments? Let me know. Can there be a scope of devaluation done by the government? Can the government go for devaluation of the currency? Of course, yes. They can go for devaluation. For example, some of you are saying no, there is a scope. I'll give you current affairs example. There is always an allegation. I repeat, there is always an allegation that China devalues its currency. Check it in the Google, you will understand. Okay, there is always an allegation that China devalues its currency. What is the reason? You will understand in some time. Please have patience. So when you have not the market but the government deciding exchange rate, there is always a scope of playing with these exchange rates. And if you do play means again change, adjust the exchange rate, so automatically it will have a larger impact on the trade. And whenever it is a fixed exchange rate, right, government can use its policy for its own benefit. But in international trade, please tell me, if China will benefit in international trade between India and China, if China will benefit from the trade, does it not mean that India basically is losing out on the trade? Think logically, please think logically. Between trade between India and China, if China will export more and more to India, it means China is getting the benefit. Right? India will end up losing because we are paying more and more dollars to China. So that is the reason. Remember the concepts. Please remember the concept. In that context, what do you think is a better one? Governments are deciding the exchange rate or market deciding the exchange rate? I hope you understand now. What would you prefer? Government deciding the exchange rate or markets deciding the exchange rate? My dear, you should choose market. Even now, some of you are saying government. No, government should not decide. Again, you have a very narrow viewpoint. That's the reason you say government. Because you think of only government of India. Think of it. You're thinking about only government of India. My dear, if government of India will decide exchange rate, can the same thing be done by Chinese government also? Think of it. Don't have a narrow viewpoint. You're talking about international trade. You're not talking about domestic trade. You're talking about international trade, exports, imports, etc. So when you have international trade, if government of India will start fixing exchange rate, Chinese government will also do the same thing. Japanese government will also do the same thing. USA government will also do the same thing. Then don't you think that will basically contradict, each of their policies will contradict with each other? Because let me show now. Let me show you now. Right, before going forward, I'll show you what is the impact of it. Now please tell me, right, can I say in case of India? In case of India, we do not use a fixed exchange rate. We use a type of floating exchange rate which is called as managed exchange rate. How it is managed, you will understand in just 2 minutes. Have patience. It is managed. What is managed? How do we manage exchange rate? You will understand in 2 minutes. Before that, what is the impact? What is the impact? Right? What is the impact of appreciation, depreciation, revaluation, devaluation, etc.? What is the impact of it? Let's start. So have a look at this. Imagine today exchange rate is $1 is equal to 50. After 1 year, it is $1 is equal to 50. Please tell me, compared to today, what do you think will happen to imports after 1 year when the exchange rate will move like this? It is there in the table. Please look at it. Right, sir, very difficult to understand. Let's start. Imagine you're importing this bottle. Price of the bottle is $1. Price of the bottle is $1. So today, for getting $1, how many rupees you will have to pay? 50 rupees. And after 1 year, to get the same dollar, how many rupees you will have to pay? 40 rupees. So tell me, today you are paying 50 rupees. After 1 year, you are paying 40 rupees. Can I say imports will become cheaper with rupee appreciation? Anybody has a difficulty? Imports will become cheaper with rupee appreciation. And India is a net importer. India is a net importer. What do you mean by net importer? Value of imports is greater than value of exports. Value of imports is greater than value of exports. That is the meaning of net importer. Now please tell me, a country which is a net importer, rupee will start appreciating or rupee is revalued. Don't you think imports will become very, very cheap? Imports will start flowing to a greater extent into India. As a result of this, what do you think will happen to domestic manufacturing? Think of that also. What do you think will happen to domestic manufacturing? Domestic manufacturing would be affected. Would be affected by this. On the other side, what will happen to, right, imports when there is a depreciation or devaluation of the rupee? What will happen to imports? Exactly opposite. Exactly opposite. Today, you will import this bottle at 50 rupees, and after 1 year, you will import the bottle at 60 rupees. What do you think will happen to the value of imports? Don't you think imports will become costlier? Imports will become costlier. Now tell me, if a government follows a fixed exchange rate, those who are asking what is the problem with fixed exchange rate, now tell me, if the government of India follows a fixed exchange rate, they want to reduce imports coming from China, can they devalue their currency? Think of it. Can they devalue their currency? If they devalue their currency, don't you think that will have a huge impact on the imports? Some of us saying no. My goodness. Listen to what I speak. You people do not listen. That's a reason you will have a doubt. You will answer wrong. If government of India, rather than controlling the imports of laptops from China by imposing licensing regime, have you come across a licensing regime for laptops now? Right, let me know. Have you come across that or not? Very recent, it was there in the newspaper. So rather than imposing licensing regime on import of laptop, don't you think government of India will simply devalue the currency to a very great extent so that computers when they import it will become very costly? I hope you understand. Right? Laptops will become very costly. So don't you think you are using your right a devaluation of the currency? You are using your currency to punish right other countries to disrupt trade. Now, can the other country also do the same thing? Think of it. Now at least it should be very clear why market determined is better compared to governments determining it. If you are going to do that, don't you think other countries will do the same thing to you? And what it will lead to? It will basically lead to a war between all these countries. War means trade war. Do not literally imagine they will take tankers and start entering into India and China like this. Trade war. Right? Every country will have these kind of policies, protectionist measures, as a result of which international trade would be disrupted. Better than this, don't you think? Market determination of exchange rate is always better. At least now this should be clear. Don't keep on asking what is the problem then. What is the problem then? Market determination is always better. Right? So this is in regards to imports. What about exports? Right? Let's start. You are exporting this bottle. Right? I'll take simple numbers. You are exporting this bottle and you want to earn 100 rupees. You want to earn 100 rupees. Today exchange rate is $1 is equal to 50. Can I say you will export it at $2? Any difficulty? Right? You are exporting this at $2. And after 1 year, the exchange rate is $1 is equal to 40. You want to earn same 100 rupees only. Will you export this bottle at $2 now? After 1 year, let me know. After 1 year, will you export it at $2? If you say yes, sir, I'll export it at $2, my dear, please look at the exchange rate. Right? You'll get only 80 rupees with $2. You want to earn 100. So what will you do now? You will increase the value of the bottle to $2.5. Now please tell me, if you increase the price of the export to $2.5, is it going to become cheaper or expensive in the international market? It is going to become expensive. And if it is going to become expensive, will your export competitiveness increase? Think of it. If your exports cost will increase now from $2 to $2.5 in the international market, do you think your products are competitive, more competitive in the international market? No, they'll become less competitive. They'll become less competitive. Okay, so competitiveness of exports will come down with the rupee appreciation or revaluation. On the opposite side, take same numbers, do not change anything. You want to earn 100 rupees. Today $1 is equal to 50, which means you will export it at $2. Now after 1 year it will become $1 is equal to 60. Can I say you will earn 100 rupee even at $1.67? Let me know. You will earn 100 rupee even at $1.67, which means now, right, you will export this product at a lower price compared to last 1 year. So competitiveness in the international market will go up. Any problem in understanding this? Right, so remember this equation. Please remember this equation. Appreciation, depreciation, or revaluation and devaluation. Whenever rupee appreciates, imports will become cheaper, but exports will start losing their competitiveness. And whenever rupee depreciates, imports will become costlier and exports will become more competitive. Please remember this equation. UPSC has questioned on it and it will continue to question on it, because this is a right important impact of appreciation, depreciation on India's imports and exports. Now, please tell me, what will favor China? Will revaluation of the domestic currency or a devaluation of the domestic currency? What do you think will favor China? Let me know. Right? What do you think will favor China? Whether revaluing their currency or devaluing their currency? What do you think will favor China? Devaluation of their currency will favor China. So at least now, right, I hope you understand why there is an allegation, that China goes for devaluation of its currency. I hope you have understood. Can we go forward now? At least now is the logic okay? Why there is an allegation that China devalues its currency? Because China doesn't follow a floating exchange rate like this. They follow a pegged exchange rate. They call it as a pegged. Pegged means they will simply say 5 yuan. Just an example, 5 yuan plus 1 yuan. Meaning what? Maximum level of depreciation. At maximum level, I will allow the domestic currency to fall down is 6 yuan. And maximum allowed appreciation of domestic currency will be 5 yuan for every dollar. So this is the concept of a pegged exchange rate. Pegged, that is basically you're fixing this exchange rate, but with certain flexibility. And some of the authors will also use the term floating pegged exchange rate. Okay. So do not worry about it. If you have understood, good. Otherwise, leave it. For China, you don't worry. You don't do PhD in China now. Okay, so this is the impact of rupee appreciation, rupee depreciation. This is how exchange rates are determined. Now, please tell me, continuous uncontrolled appreciation, is it good for India? Let me know. Continuous uncontrolled appreciation, good for India? Anybody says yes, sir, very, very good. Continuous uncontrolled depreciation, is it good for India? So argument is simple. If there is a sudden, that is very important, sudden appreciation or sudden depreciation, it is never good for Indian economy. Never good for Indian economy. But if you say, if you are following a floating exchange rate, 100% floating exchange rate, can this happen? Correct or not? If you say, sir, I'm having floating exchange rate, 100%, pure 100% floating, which means no way, right, anybody else apart from the market will determine exchange rate. So if you follow 100% floating exchange rate, in that case, can suddenly the rupee appreciate? Yes. Can suddenly the rupee depreciate? Again, answer is yes. That is the precise reason in India we do not follow complete floating exchange rate. We follow a type of floating which is called as managed floating. We follow a methodology called as managed floating exchange rate. Managed market determined exchange rate. Now, what is this idea of a managed floating here? Generally, that is most of the times, we allow supply and demand for the currencies to determine exchange rate. I will repeat the statement. Listen now carefully. Most of the times, we allow market forces, that is supply and demand for the currencies, to determine exchange rate. But if there is a sudden appreciation, sudden depreciation of the domestic currency, Reserve Bank of India will intervene in the market and stabilize exchange rate. I repeat, if there's a sudden appreciation or sudden depreciation, then RBI, Reserve Bank of India, will intervene, will participate in the market and stabilize exchange rate. What do you mean by stabilize exchange rate? If there's a continuous depreciation, they will try to control the depreciation of rupee. If there is a continuous appreciation, they will try to reduce the appreciation of rupee. How so? Let's start. Imagine rupee is continuously depreciating. Very fast, continuous rupee depreciation is happening. So can I say rupee depreciation means supply of a rupee is very high, demand for dollar is also very high? Yes or no? Please do let me know. Right? Basic concepts will apply now. If rupee is continuously depreciating, what does it mean? It simply means in the market, that is in the foreign exchange market, there is a lot of rupee being sold, lot of dollars being purchased. Correct or not? Please participate. Please participate. And this is the reason why continuously fast rupee depreciation happens. Is it good for trade? Is it good for investments? Is it good for other types of transactions? Not good. Instability. Sudden depreciation, sudden appreciation, never good. And now what does RBI do? What does RBI do? RBI basically, understand this. RBI, if demand for dollar is very high, RBI will sell a dollar to the bank. Simple idea. Imagine this is a bank. Okay, imagine this is a bank. From the market, lot of people, investors, individuals, etc. Lot of people, they are selling rupees and they are buying dollars. Agreed? Bank is part of the forex market. Bank is part of the forex market. No, RBI doesn't like it. RBI says suddenly, right, so quickly, right, rupee should not depreciate. So what does RBI do? RBI will sell dollars. RBI will sell dollars and in return purchase rupees. RBI will sell dollars and in return purchase rupees. Now please tell me, in the step one, supply of rupee was increasing, demand for dollar was increasing. And in the step 2, RBI will supply dollar and purchase rupees. Don't you think this will stabilize exchange rate? Think of this and please do let me know. If RBI does this, don't you think it will stabilize exchange rate? Because the demand for dollar is very high, RBI will sell a dollar. Right? And supply of rupee is very high. So supply of rupee high means value of rupee will start falling down. RBI will start purchasing rupees. This is how RBI will stabilize exchange rate. Now, can RBI do opposite also? Can RBI do opposite also? Of course, yes. Imagine rupee is continuously appreciating. Imagine rupee is continuously appreciating. Means what? Supply for dollar is very high in the market. Demand for rupee is also very high in the market. So now what does RBI do? RBI will go to the forex market, that is banks and other institutions. RBI will basically start selling rupees and purchasing dollars from the market. So logic is very simple here. Anything which is supplied more, RBI will purchase. And in return, this is an exchange rate. In return, will supply the commodity whose demand is more in the market, thereby stabilizing exchange rate. Thereby stabilizing. And that is the precise reason. Right? RBI, we say, will stabilize, manage the exchange rate in India. Any difficulty? Can we go forward here? How both demand will increase? Who said demand for both will increase? You tell me. Did I say demand for both dollar and rupee is increasing simultaneously? Did I say that at any point of time? Let me know. Did I say supply for dollar and rupee simultaneously is increasing? No. It is an exchange rate. So supply of rupee increases means demand for dollar is very high. What does RBI do? Supply of rupee is very high. RBI will purchase rupees. Demand for dollar is very high. Supply dollars to the market. That's it. Right? Exactly opposite to what is happening in the market. Exactly opposite to what is happening in the market. That is the role of RBI. Now, two very important points here. Two very important points. Point number one, if RBI wants to sell dollars, from where does RBI have the dollars? I hope you understand my point here. If RBI wants to sell the dollars, RBI should have dollars. Now, do you remember forex reserves? Tell me, do you remember forex reserves? So RBI has a forex reserves. RBI is the custodian, manager of forex reserves. So all of you will agree, RBI has a forex reserves, will use the forex reserves. That is, it is a sale of forex reserves. It will sell the forex reserves in the market so that the exchange rate is stabilized. Anybody has a problem with this? Please do let me know. Anybody has a problem with this? Right? On the other side, imagine, understand this carefully. Imagine rupee is right. Rupee is appreciating. Imagine rupee is appreciating, which means supply of dollar in the forex market is very high. Demand for rupees is very high. What does RBI do? RBI will buy dollars. RBI will simply buy dollars because supply is very high. And in return, right? In return means instead of a dollar, they will give, right, the rupees to the market. Now, please tell me, if RBI will sell rupees in the example 2, what will happen to the supply of rupee in the market? Let me know. If RBI will sell rupees, what will happen to rupee supply in the market? Don't you think rupee supply will start increasing? Don't you think rupee supply will start increasing? If rupee supply increases, is there a danger of inflation? Start connecting the dots. Is there a danger of inflation? Yes. Now, what does RBI do? So, this is a dilemma for RBI. I hope you understand. This is a dilemma for RBI. On one side, RBI is supposed to stabilize exchange rate. So, to stabilize exchange rate, RBI is selling rupees. But because RBI is selling rupees, it might lead to inflation in the market. Now, what does RBI do? RBI will use open market operation. Simple. RBI will use open market operation and sell bonds, reduce money supply from the banks. Simple. On one side, money supply will increase. On the other side, they will sell bonds, purchase, or basically take out money from the system. Can we stabilize money supply in the economy? Let me know. Can we also stabilize money supply in the economy? Right? Whatever was the concern regarding inflation, that will also be addressed. This is called as sterilization. This is called as sterilization. What is the idea of sterilization? Reserve Bank of India, because they are intervening in the forex market. I repeat, Reserve Bank of India, because it is intervening in the forex market, there could be, right, there could be addition to inflation. Inflation might go up. And in order to control this inflation, Reserve Bank of India will use other tools to reduce money supply. This is called as sterilization. This is basically the sterilization. Done. Can we go forward now? This was asked in this year UPSC. Right? One of the students says, sir, it was asked in UPSC. Yes, this was asked in this year's UPSC itself. Can we go forward now? What is open market operation? My goodness. What do you mean by open market operation? My dear Reserve Bank of India, open market operation is one of the tools under monetary policy where RBI either sells or purchases government securities in order to either increase or decrease money supply. Very simple. Okay. Sterilization again. I'll repeat it again. If rupee is appreciating, what does RBI do? Please tell me. If follow the sequence. Follow the sequence. If rupee is appreciating, what is the meaning of it? Supply of dollar is very high. Demand for rupee is very high. Okay. Supply of dollar is very high. Demand for rupee is very high. What does RBI do? RBI, right? RBI will sell rupees and purchase dollars. RBI will sell rupees. Okay. So that rupee will get stabilized. But now the question is, if RBI will sell rupees, rupee supply in India will increase. Correct? If RBI is selling rupees, in addition to whatever rupees are there in the economy, more rupees will get added. And when more rupees will get added, there is a danger that inflation can be caused. So what does RBI do? On one side, it will sell rupees so that, right, rupee will get stabilized. On the other side, RBI will use OMO to reduce the rupee supply in the market. So on one side, rupee is increased. On the other side, rupee is decreased. Supply, that is. This is called as sterilization. This methodology is called as sterilization. Okay, done. So rupee appreciation, depreciation related to exports and imports. I'll repeat it again. If rupee appreciates, right? Have a look at this. If rupee appreciates, imports will become cheaper. Look at the numbers, my dear. You will have to look at the numbers. If you can't look at the numbers, then don't keep on asking what is the problem, why it is happening. Look at the table. Today, $1 is equal to 50. After 1 year, $1 is equal to 40. Means today you are paying $1 for this bottle, which is for 50 rupees. After 1 year, you will pay 40 rupees, which is nothing but cheaper. Import will become cheaper. Now imagine you are exporting this. Imagine you are exporting this. You want to earn 100 rupees. So if you export it today, you will have to export it at $2. After 1 year, if you export it to earn 100 rupee, you will have to export it at $2.50, which means your exports price have increased in the international market. They'll become less competitive. On the other side, if rupee is depreciating or it is devalued, right? In case of imports, same $1, you'll pay 50 rupees today. After 1 year, you'll pay 60. Imports will become costlier. And in case of exports, you want to earn 100 rupees. So at $1 is equal to 50, you'll export it at $2. At $1 is equal to 60, to earn 100 rupee, you'll export it at $1.67. Which means in the international market, your product has become cheaper, which will increase its competitiveness. That is basically the idea. Okay, done. Let me go forward now. What are the factors which will influence exchange rate? What are the factors which will influence exchange rate? First one, interest rates. We'll discuss current affairs here. You will have to listen carefully now. If you're not listening, please listen. These are very tricky. Listen. A country which will offer higher interest rates will attract more foreign investors, thereby leading to increased value of the domestic currency. What do you mean by that? I'll give you a very simple example. Country 1, country 2. In country 1, interest rate is 4%, meaning your investment will earn you 4%. In country 2, your investments will earn 6%. So simple question to you people. Will you invest your money in country 1 or country 2? Let me know. Will you invest your money in country 1 or country 2? Some of the students, I'm actually surprised. They're saying country 1. Why? Those who are saying country 1, please enlighten me. 6 a.m. today, please enlighten me. Let me also become like Buddha. How? What is your argument? Why do you say you will invest in country 1, earn 4%, where you can invest in country 2, earn 6%? What is your argument? Right? Let's change the reverse. Let's reverse all the rules in the international market. What is the argument? Let me know. My dear, why will you invest and earn 4% when you're capable of earning 6%? What is the argument? No, you will not invest in country 1, you will invest in country 2. Can I say, with higher interest rate, more foreign investment will flow into country 2? Simple, step by step. With higher interest rate, more investment will flow into country 2. And if more investment will flow, let's say, what will happen to dollar? Dollar supply will increase and demand for domestic currency will increase. That is exactly what I've written here. And if the demand and supply will change, don't you think exchange rate will also change? Point number 1. Now let me add to this a current affairs concept called as Fed tapering. Understand this very carefully, important for UPSC. Fed tapering. Point number 1. What is this Fed here? Fed is Central Bank of USA. Federal Reserve is equivalent to RBI. RBI is the central banker in India. In the same way, we have Federal Reserve in USA. Point number 1. Point number 2, what do you mean by the term tapering? Tapering simply means reducing. Okay, reducing, narrowing, constricting. Tapering means reducing. Point number 2, what is the Fed tapering then? What is this Fed tapering? Why it is done? Let's start. Imagine there is either a recession or slowdown in the domestic market. Okay. Either there is a recession or there is a slowdown in the GDP value. Now, please tell me, you are the central banker. What will you do when there is a recession or a slowdown? Will you increase the interest rate or will you reduce interest rate? Let me know. Will you increase interest rate when there is a recession? Then please do not become central banker. You will destroy the economy. You will push the economy into depression. So all of you will agree, you will have to reduce interest rate. Any problem with this? You'll have to reduce because you want to increase money supply. You want to follow expansionary policy. All of you are okay with this? You want to follow expansionary policy. And this expansionary policy followed by the Federal Reserve, that is called as quantitative easing. Do you understand the term quantitative easing now? Please do let me know. Quantitative easing. Please remember quantitative, qualitative, quantitative easing, expansionary policy, increase the money supply. How will you increase money supply? Reduce interest rates. Reduce interest rate, purchase more and more bonds from the market. Automatically, money supply will increase, interest rate will go down. Point number one. Now, if the interest rates will go down, money supply increases, don't you think more people will start taking loans now at lower rate of interest? More companies will start taking loans now because rate of interest is lower. That is exactly the second point. If companies, right, investors, people, etc., start taking more loans, the GDP will start reviving, production will start taking place, employment will start happening, right? There will be growth in the GDP. Can I call this as a recovery? Now, what if unemployment rate has gone down? GDP growth rate is increasing. Is there a danger that if the same money is there in the economy, that can cause inflation? Think of it. All of this we have discussed earlier. Nothing is new. Right? So I will repeat it. If interest rates are lower, money supply is already very high, GDP is also higher, right? Unemployment rate is going down. Don't you think it is a recipe for inflation? So do you think central banker will sit quiet and allow this to happen? No. So what does a central banker do? In order to control inflation, right? In order to control inflation, the Federal Reserve will start reducing money supply. Very simple. In order to control inflation, the Federal Reserve will start reducing money supply. Now, can I say, if they are reducing money supply, it is opposite to quantitative easing? Let me know. Can I say this is opposite to quantitative easing? And the term they use for reducing money supply now is called as federal tapering. Very simple. The term they use in order to reduce money supply now, it is called as federal tapering policy. And what will happen in federal tapering policy? Increase interest rate. Simple. Keep on increasing interest rates. Right? Do not buy more bonds in the market. Keep on increasing interest rates. So if the interest rates will start increasing, loans will become costlier, right? Less people will take loans, less companies will take loans now. Don't you think money supply automatically in the economy will come down? Any problem with this process? Please do let me know. Any problem with this process? Please do let me know. Right? There is one student who says, if I read economy, I will do better. My dear, if you can do better, please do that. I don't have any problem. At the end of the day, question should be, are you able to understand economy or not? Okay. Any problem here? So federal tapering is opposite to quantitative easing. That's what exactly I said. That is exactly what I said. Right? In quantitative easing, money supply will increase. In federal tapering, money supply will be decreased. That's it. That's the basic idea. Now, interest rates in USA are increasing. Let's start the game now. Interest rates are increasing in USA. Tell me, foreign investors from India, don't you think they will start taking their capital and start moving towards USA? Yes or no? We have discussed this in the beginning of the class also. In interest rates in USA, if they start increasing, can I say you can see a capital flight from India? Yes or no? Those who have attended first session, it's very easy for them. Those who have forgotten what we did in the first session, great. Right? So there will be flight of the capital. Foreign investors in India, they'll start selling. They'll start selling their instruments in Indian market. They will take the rupees, convert the rupees into dollars. They will convert the rupees into dollars, take the dollars out of India. So point number one, can I simply say, if there is a Fed tapering in USA, if there is a Fed tapering in USA, it might lead to rupee depreciation in India. Let me know.